Obviously, we're all in Bitcoin for the tech and maybe a little bit of profit too, but does Bitcoin also help us to predict recessions and pullbacks in traditional markets? Let's find out. Today we're going to be looking whether BTC can predict recessions, and where better to start than looking at the S&P 500 versus Bitcoin as well as their correlation. So we can see here over the past 5 years, looking at a 30-day correlation between this blue line here, which is the S&P 500, and this black line, which is the BTC price action, we can see there is quite often a very strong correlation between the two. Now this is just generally because Bitcoin and traditional markets, especially equity indexes like the S&P 500, are more risk-on assets. And I know there is a narrative of Bitcoin potentially being a hedge against inflation and decoupling from traditional markets, but ultimately the correlation is plain to see and undeniable. Potentially in the future this may change, but if we especially look at a 6-month correlation between the two, we can see that over the past 5 years it's very rare to have any uncorrelated price action between these two assets. But like we said, can we actually use BTC and its volatile speculative nature as well as the correlation between the assets to potentially predict recessions and downturns in traditional markets? Now the way we can really do this is to look to see if Bitcoin is potentially having these blow off tops and potentially starting its bear market a little bit ahead of the S&P 500. But this also works for the upside. We can potentially look to Bitcoin as markers of when the market has potentially bottomed out. Now obviously in hindsight this is much easier to do, and in the future this may not be as simple. But if we can look to this and potentially find some confluence with some other metrics, it may really help us time our investments a little better. So if we just go to the S&P 500 versus Bitcoin and the year-on-year rate of change, we can again see S&P 500 in blue here and its percentage year-on-year rate of change, as well as Bitcoin in the black here. Now if we just zoom in to specific bull market peaks in the Bitcoin price action, we can see that usually these occur pretty close to when the S&P 500 and most traditional markets are also topping out. If we just see here, for example, as Bitcoin peaked in this double peak cycle in 2012, 2013, we can see it was very close to when the S&P 500 marked a local high before having a bit of a pullback. Now in this example here, on the second of Bitcoin's double peaks during that cycle, they did top out at pretty much the exact same time. But following that again, we have 2017 here where Bitcoin topped out and the S&P 500 was not so far behind. And again here, as Bitcoin topped out, we can see the S&P 500 was only a few days behind that. We can actually just look to see the actual dates here. So the first one for Bitcoin was in April, and then the S&P topped out in May. As we said, these were about the same, but in 2017, Bitcoin topped out on December 17th, whereas the S&P topped out around mid-January. And again here in 2021, when Bitcoin initially surpassed $60,000, we can see it topped out here in March before the S&P topped out again in March, but about 10 days later. And then even if we look to the next all-time high peak we set in October 2021, this happened, as we said, October 20th for Bitcoin, and then in the S&P 500, November 1st. So it looks like there's a little bit of a lag with the S&P topping out and Bitcoin actually topping out. But again, like we said, this isn't just true for potentially marking out market peaks. If we just go back to this correlation chart here, we can see that Bitcoin again bottoms out usually a little bit before the S&P 500. So we can see here in December 2018, Bitcoin bottomed out on December 15th, whereas the S&P December 24th. The COVID 2020 crash, Bitcoin was March the 12th, the S&P was March the 23rd, and the only example where these don't quite line up is this most recent cycle here. Now, this could be for a number of reasons. We could say that without the FTX collapse, obviously this is a little bit of speculation, maybe we wouldn't have had a new dip to a new cycle low here. Maybe this would have been the bottom or potentially a double bottom here. But we can see here that if this was the case, then Bitcoin and the S&P 500 bottomed out at about the same time. Maybe the Bitcoin was a few days ahead of schedule again. But like we said, this is a bit of an anomaly because we did have a further dip to the downside rather than just potentially continue on a maybe more natural course of price action. But why do we actually see this phenomenon happen where Bitcoin is potentially bottoming out and peaking just prior to traditional markets? Well, it's likely due, like we said, to the speculative and volatile nature of Bitcoin and cryptocurrencies. Usually investors with a huge portion of their capital in these much more volatile speculative markets, which are used to having potentially hundreds of percentage moves to the upside, but then also vast drawdowns of 70, 80, maybe even 90% to the downside, they're usually not going to have a vast portion of their capital in these markets, just due to the percentage moves we usually see. Now, obviously, like we said, this is great for catching these exponential moves, so maybe people are a bit more eager to put their capital in at potentially the most opportune moment when Bitcoin and the crypto markets are heavily discounted, just to try and obtain at the most opportune price. But again, as Bitcoin tops out and really gets to the exponential end of a bull cycle, maybe again people are much more willing to take profit on a much more speculative asset. Now, until the actual correlation between these two assets subside and we actually see a bit of a Bitcoin decoupling, then maybe this phenomenon will cease to exist. But I think a lot of the correlation is just due to larger economic factors that are impacting both Bitcoin and the S&P 500 and just traditional markets in general. Looking to metrics such as the Fed balance sheet versus BTC, we can again see there is a fair bit of correlation to when the Fed balance sheet is expanding and we're seeing central banks loading up on assets and Bitcoin's price increasing. Now, once we see a decrease in the federal balance sheet, we can again see Bitcoin tends to decrease. There may be a little bit of a lag and a delay on this, but generally once we see huge capital inflows and the Fed balance sheet really expanding, we see huge exponential run-ups in the Bitcoin price. Now, this is indicating more bullish economic market conditions, and this ultimately affects both Bitcoin and traditional markets. So it's unlikely we're going to see this uncorrelated decoupling for a sustained period of time anytime soon. But like we said, we can use this knowledge, the fact that Bitcoin potentially indicates us to changing market conditions with a little bit of a more reactive nature than other traditional markets, alongside other data points and tools for confluence to try and better time our investments. Also, if you haven't already, please don't forget to like this video, subscribe to the channel and turn on notifications to ensure you're receiving all of our content as soon as it's released, and make sure to check out all the resources we've discussed today, as well as the many more that are all available on lookintobitcoin.com, your #1 source for Bitcoin information. So just to summarize, given the correlation between the crypto markets and traditional equity indexes like the S&P 500, we can potentially look for clues in one industry that are likely to affect the prices of other assets. And as Bitcoin represents a more speculative and risk-on asset with a much smaller market cap, it can be more sensitive to capital inflows and outflows. And Bitcoin has on multiple instances during its lifespan reacted faster during extreme market conditions, potentially outlining the asset's ability to mark market tops and bottoms on a much broader scale. If you like this video, then please visit lookintobitcoin.com, where you can also consider becoming a site subscriber to gain access to professional resolution charts, advanced macro and portfolio data tools, in-depth crypto industry reports, live and personalized indicator alerts, private TradingView scripts, and more, all for a fraction of the standard industry price. And let me know what your thoughts are on potentially using Bitcoin and digital asset markets to potentially mark tops and bottoms in much more wider and traditional asset classes. As I said, let me know in the comments down below and on social media. I look forward to reading and replying to all of them. Thank you very much for watching, and I'll see you in the next one.